Okay, thank you very much, Kirway. This is Michael Weiner, um, partner here at Fox Rothschild. I'm here with my partner, Vince Vietti. We are in the same office, but in separate secure locations. Um, very happy to be here, participating in the Venture Cafe and sharing a little bit of our experience and insights into the negotiation of primarily Series A term sheets. At least that's really the focus of this particular presentation. Just a little bit about me. Um, this is my 40th year of practice. That number gets harder and harder to get out each time I say it. Previously, I was a co-chair of the emerging companies practice group here at Fox. I spend a lot of my time on the M&A side, and also a substantial amount of my time working with early stage and growth stage companies of various industries, a very broad spectrum of industries, and sometimes working with them in the capacity as an outside general counsel for companies that really haven't gotten to the point where it makes sense for them to have an inside general counsel. And so a lot of day-to-day contact with companies, helping them to get set up and really helping them to avoid the mistakes a lot of times that are made along the way, so that they are best positioned for whatever it is that they perceive to be their next step in their evolution. And Vince?
Thank you, Mike. I'm Vince Vietti. I also am a partner here at Fox Rothschild. We're both housed in the Princeton, New Jersey office. I'm a bit younger than Mike. I'm only in my 20s as a lawyer, but close to 30 years. So I've been practicing a while myself. I am a corporate lawyer. My client base runs the gamut between early stage to venture-backed companies to public companies. So various middle market companies, but across the board on size, industry, software companies, medical device companies, industrial companies, engineering companies, defense contractors. So not really an industry focus, but most of my practice, like Michael's, I think, we're mostly on the issuer side of these kinds of transactions, these kinds of venture deals. Many of our clients are, like I said, venture-backed, or certainly have raised outside money. So we are, focused mostly on day-to-day corporate work, M&A work, financings and the like. And it's nice to be here with other people. We've ourselves have just come back into the office voluntarily. I think Michael's down the hall. We're probably about in the very small minority of people that say it's not so bad being back in the office. So with that, I will probably just turn that over to Mike, and we'll start racing through this term sheet. And if you want to chime in with questions, please do.
Yeah, absolutely. Look, we understand we have 45 minutes to cover really what's arguably a lot of stuff, right? So hopefully each of you has received the form of term sheet that we asked to that we positioned as the sort of the basis for this discussion. The term sheet is taken from the NVCA, the National Venture Capital Association form documents. Over the years, lawyers or advisors who spend a lot of time in this particular area have sort of coalesced and said, well, it doesn't really make much sense to keep renegotiating, our own special forms each time, we do a deal. So there is this collection of form documents that most firms will at least start with. So just, real quick, let's just talk about the environment for Series A investments. Obviously, if we were having this chat 4 months ago, 5 months ago, we would be taking, a somewhat different perspective on things. The reality is, well, you all know what the reality is, right? So the world changed virtually overnight. And one of the products of that reality is that, Series A deals that, right now, they're not getting done with any high degree of frequency. Later stage transactions, growth equity type transactions, much more volume in that segment of the marketplace. So when Vince and I were talking about this earlier, what we would like to do is to, try to help people position themselves to be in the best possible place when, and nobody's expecting there to be, you just flip a switch and everything goes back to, however you define normal, right? But to be best prepared to entertain, to plan for and entertain offers that will hopefully come your way, in the context of an early stage financing. To give you just a real quick summary of what the market was like before COVID, right? BC. The median valuation of Series A rounds was in the $25 million range. The median percentage acquired in the Series A round, about 25%. The median amount raised in a Series A round, $4 million. The median age of the company from founding to closing its first round of financing, 3 years. And the median time between rounds, about 1.5 years. Now, again, reality, most VCs, yes, they're sitting on, I'm sure you've heard the term dry powder, private equity funds, VCs, everything in between, everything in that spectrum. Their focus right now, and quite frankly, understandably so, is on their existing portfolio companies, as opposed to really, making new investments, unless it's something which is just, so compelling that that they feel the need to jump in, notwithstanding all of the uncertainty. Yes, they're venture capitalists, they take risks, but they only take risks up to a certain point, okay? Because they have limited partners to answer to as well, right, in their funds. So there's a high degree of skepticism, which is a byproduct of the uncertainty that we're all living with. And so, I'm sure you've heard this as well. The toughest money to get is the first money. That's always the toughest money. So what we'd like to talk about in the context of the form of term sheet that hopefully you've all had a chance to open up is there's really two core concepts that go into any term sheet. One is the economics, and the other is governance.
Mike, can I chime in just for 1 second?
Please, because I'm getting tired of talking.
Yeah, we'll try to tag team this a bit. We've worked together for a few years. Like you said, there's not a lot of Series A deals going on now, and as you mentioned a bit earlier, what can you do now to get yourself in a good position to do that? Just a couple of pointers assuming most of this crowd is on the company side, issuer side. While we're in this zone of perhaps it's not as active in the earlier stage financings as in the past, two things that are big deals for investors that can cause you some headaches is your IP portfolio. Spend some time now in getting that IP portfolio in order as best you can. Protecting yourself, certainly if you have patented technology or the like, and certainly with non-confidentiality agreements and the like to protect your trade secrets. So focusing on getting your IP in order, good thing to do. The other big thing where we see issues, and this came up in a call today with the large investment bank, and that's the cap table. There's always cap table problems, it seems, in these kinds of companies. But early stage companies, it just happens that way. People are promised some shares, they come in and out of the company, you got consultants. So that would be the other thing I would say is to get your cap table in order, because those are to me the two of the big due diligence items to get to the point where you'll get your hands on a term sheet. I think a good corporate paralegal is a good thing in that front. People typically often hire outsiders to manage their cap tables these days. So just a couple bits of advice to get you in a nice position to hopefully get a term sheet. With that, Michael, I'll just turn it back over to you for.
Yeah, no, those are great points, and those are real world kind of points, right? I mean, I closed an investment round last week, I think it was, but one of the things and I was on the investor side, okay? So one of the things that we had the company running around doing at literally the 11th hour was getting the sign off on a patent assignment for really the key piece of intellectual property into which my client was investing. And there was a high degree of uncertainty based upon our initial due diligence as to who actually owned this technology. And it was, unfortunately, not all that surprising that the company wasn't sure who owned the technology. And so we really had to push them, and as Vince said, to to get their IP portfolio clear as to who owns what. And look, you all know, sometimes you only get to make a first impression. And if you can't make a positive first impression, you're really going to be at a disadvantage. So just going back to what Vince and I had discussed as being sort of the two core concepts that we wanted to address today. One is economics and the other is governance. Economics is essentially valuation. We are not here, first of all, we are not valuation experts. We are not here to try to give any sort of advice as to how you ought to be doing your pre-money valuation for purposes of determining the related economics. That is something which is many times, particularly with pre-revenue companies, much more art than science. The VCs will come in and they will have a valuation based upon their due diligence. You may have some disagreements. I think if you're on the company side, you're always going to think the valuation is lower than it should be. But Vince and I were talking about this earlier. There's a balance to be struck. If you value too high, then you're at an increased risk of a down round, which next time, which really nobody wants. And so there is the idea of maybe trying to strike a little more favorable balance insofar as the company is concerned between valuation and governance rights. Okay, but really everything really springs from valuation, because you're going to be issuing convertible preferred stock, and it's going to be convertible into common stock, and the conversion price is going to be the initial purchase price, right? So it's going to be on a one-to-one basis. So when you're looking at the dilution factor of your round of financing, you always want to keep in mind that it is the goal of the VC to get the company to a point where it wants to convert into common, because that's really where they make their money. They don't make their money just based upon getting back whatever amount they invested by way of what you've probably heard referred to as a 1x liquidation preference. Okay, they want to get some sort of multiple, a pretty strong multiple return, and that's going to be based upon their ability to convert their preferred shares into common. So you really want to understand the math of that and the economics of that, so that you can really evaluate many of the other terms that will come into play in terms of corporate governance and class voting rights and the like. Vince, you want to talk about that a little bit?
Sure. You want to move into some governance? So, right. So the typical Series A term sheet, which you have in front of you, a lot of it's focused on governance, corporate governance. We see that, I think you see three sort of main components in that. Right out of the gate, board seats, the board composition. Then you have class voting rights for your Series A investor, right? The investor gets its own class of stock, so they negotiate for special voting rights. And then the third sort of flavor of governance is special approvals, where certain items require approval by the Series A directors. So, and that gets us segues into a different area of the term sheet here in the investor rights agreement. So turning to the board seats. So one of the initial issues you deal with is what's the board going to look like? And typically the Series A investor in sort of the paradigm a few months back, if you looked at the numbers, they end up with 20 to 30% of the company, give or take, in that range. And they might get 2 out of 5 board seats. So the first thing is, how many board seats do they get? Typically, the founders would still control the board at this point. And so you'd have 2 board seats to your investor. Where they really protect themselves is in their special rights as a Series A stockholder. And we call those class vote rights. I don't know if the term sheet calls them they call them protective provisions. And what those are certain actions that the company can't take without the consent of the Series A holders as a stockholder, their stockholder vote. You can't do these certain things unless those investors approve of them. These are often the most important things to the investor. They're often the events that have the biggest impact on a company. I typically look at those as sort of capitalization table events, cap table events. Dividends, they need your approval. A new class of stock, you'll need their approval. A superior class of stock to the Series A, you'll need their approval. Doing a merger, buying a business, acquiring assets, issuing shares, perhaps even issuing shares. So big things that affect the cap table, and these investors will insist that they have a stockholder vote on those issues. And the reason they want it there is because they have no fiduciary obligation. As a director, when they sit on your board, they have to make decisions, even though they're appointed by their investor, the Series A investor. As a director, they have a fiduciary duty to the entire corporation, to all of the stockholders. So they're handcuffed a tiny bit, right? They can't do everything that's only 100% in their self-interest. But as a class vote issue, those again are the big issues, and those are the ones that they do 100% for their own self-interest. And that's why they're typically the biggest, most important items. So the third area of governance, which is another heavily negotiated point, and that's in these, I'll call them more day-to-day issues. Not more day-to-day cash flow type issues where the typical venture documents, the Series A transaction documents will say Mr. Company, you can't undertake these actions without the approval of the Series A directors. And those, again, gives them a blocking right on lots of things. And you'll find a sample of those provisions in this term sheet. I think they're under the investor rights agreement. And you'll see those are not quite as important, but still pretty big ticket items. Exclusive licenses, hiring executive officers, affiliate transactions, perhaps hiring other executive officers, entering into a loan agreement. So there, you can see there's a little bit more day-to-day. And so that's sort of where the governance comes out. And back to one of Michael's points about the whole balance here. The balance when you're doing these deals is between valuation, dilution, and governance. And this is an area where where the company, where the issuer might have a little bit more ability to make these special board approvals, take a little punch out of there. Maybe that's where you can get a little bit more governance rights. In other words, keep a little more day-to-day control, and make that list smaller in the special board approval issues. So in that balance, I think this is an area where you probably have a little more negotiating power, whereas the big ones, they're going to demand that those are class vote issues for the big, I'll call them cap table issues and the like. So that's kind of the governance picture in these types of deals. And one other point I'll make is that it's a detail, but they often have these rights, these Series A rights to certain directors and certain voting rights. And one thing you'd often try to do as a company is say, well, you only have them so long as you own some percentage of your initial investment. And so that's a little bit of an arm wrestle too. You don't want them having these rights when they've sold down to 2 or 3, 5, 10% of the company, that kind of thing. So you want them to hold a good chunk of their investment to maintain all these rights. So that's all I have on governance, unless Michael, I'm sure you have a bunch more on governance. We could go on for.
Well, I just wanted to pick up on a couple things that you mentioned, Vince, and that is, the notion of balance, right? Venture capitalists over the years have rightly or wrongly developed a certain reputation, right? You've heard them referred to as vulture capitalists and all these things. venture capitalists, I mean, they want the company to succeed, right? I mean, they want you to succeed. They're not going into an investment, trying to do anything but grow the company, because that's how they make their money. And you as a founder, if you're a founder, you have to look at it as look, I always say I'm not really good at math. Okay, I'm really bad at math. But if I'm a founder and I own 100% of a company that's worth, just something barely north of zero, because it's a completely illiquid investment, and now venture capitalists come in, and now I own, I'm just going to pick a figure, right, after a Series A round, 75% of something that is now valued at, and again, I'm just picking a number, $20 million. That kind of math I can do, and I know that I'm better off afterwards than I was before. Okay, so there, the situation should be one. The situation should be one where everyone really has a similar mindset, that we're doing this so that everybody rises up. Everybody rises up. One of the things that I did want to mention, and it springs from something that, and I just see a question popped up, which is great, and we'll get to that in a second, okay? But something that Vince mentioned about founders and founder shares and that sort of thing. One thing that, and I don't know if it's really addressed in the form of term sheet that we're working from, but one thing that founders, particularly ones who are active on a day-to-day basis in the business, are going to have to be prepared for is that you are most likely going to be expected to sign what's called a restricted stock agreement, which means that and let's just say, for the sake of discussion, we have one founder, and that founder post money is going to have 75% of the stock, right, in the company overall. Well, that 75% is going to be subject to a restricted stock agreement, whereby the stock will effectively vest over a period of time, usually 3 years or so that if you, as the founder, walk away or are asked to walk away, you stand to lose, right, some pro rata portion of the shares that you may have had on day one. Again, it's a fact of life. It's a fact of life, and you can't take it personally. I mean, you can, but you shouldn't take it personally, because all of these things that Vince has been discussing in terms of governance and these sorts of features, they're all intended to provide the investor with a higher degree of comfort in an otherwise speculative situation, that their capital is going to grow. Okay, so now I see Vince. I don't know if you have your.
Yeah, the only thing I would add to that is that is a big deal. I mean, it's a big deal. The founder, that is in the term sheet here, the founder stock.
It is, okay.
We just fought this with someone that started this business 4 years ago. And we argued, wait a sec, we built this company up over 4 years, sweat equity, we contributed IP. Why should I have to earn back my shares? And that's a legitimate position.
Absolutely.
That you've built this company up and you've earned it.
Yeah.
So I think I like to push back hard on that, if I'm in your shoes as as a company, I keep saying investor, as an issuer, because you've earned the shares already. And so I think the longer you've had your company, and the more you put into the company, the better your argument is. Well, gee, you shouldn't have to earn your shares at all. The arm wrestle might go, well, okay, I'll put 25% of the shares up, something like that.
Right,
so,
right. Listen, it's always a difficult conversation to have between the investors and the founder.
And by the way, we lost that argument. We had a tough investor, but that's the way it goes. We saved a lot of our shares, and of course, if you don't leave the company, you'll end up earning them. And I think that might dovetail into employment agreements. So
sure,
if you have if they're going to hold your stock, to me, the counter to that is to get an employment agreement. And that's, not, I don't know if that's in the term sheet. I think it might be, that's in, I'd say 50% of the term sheets. is an employment agreement for the founders, or the CEO, the CTO, whoever that person might be, or a couple of the founders. So that's sort of the counter. Fine, if my shares are gone, I'm not going to have you fire me tomorrow, et cetera. So that's another wrinkle. There's so many little pieces of this, and they all sort of intermesh. So I'll let you go, Michael. Go ahead.
There are a lot of moving pieces, and ultimately they do all need to work together. Okay, the round that I closed last week, I was on the investor side. We had the two key executives in the company execute both employment agreements and restricted stock purchase agreements. Okay, so sometimes it comes down to leverage. There are some questions that have been posed. So let's see if we can respond to those. Okay. Question: how long is the period to prepare, propose, negotiate, and close a Series A? They can be done really very, very quickly. Particularly if you as the company, to one of Vince's points earlier, have your house in order, so to speak, right? Because again, for the most part, we're going to be working from a heavily predetermined set of documents that at least the advisors are familiar with. So if you can, if the parties can get through negotiating and agreeing upon a term sheet, to move from there, and really that if people are really focused, you ought to be able to get that done in a week or so, maybe 10 days. And then to move to documentation. I mean, from start to finish, you really, if things go well, you ought to be able to get it done in 3 weeks, right? 3 to 4 weeks.
Right.
Now, the deal that I just closed, that took a lot longer because one of the founders came down with COVID, sort of partway through the process, and he was sidelined for 2-3 weeks. Okay, but I think that I would
concur with that. And I say another question here. How do you? We're not IP lawyers, but we've been around this stuff. Can you make a few comments about protecting your IP? And I guess I would say this. Well, we make employees of most companies we represent sign what we'll call covenant agreements, non-disclosure and covenant agreements. So every consultant and every employee that we would hire in an early stage company will sign a non-disclosure agreement coupled with a work made for hire, meaning everything I invent or work on is yours, Mr. Company. Those are critically important, and they also contain obligations to assign any inventorship rights, etc. So I would say that might be the biggest way to protect yourself from an employer or consultant stealing your what should be the company, since you're paying these people. 2, if it can be protected, you ought to consider filing a patent. And third thing is, in your commercial endeavors, you want to, when you're sharing and collaborating, particularly with market participants that might have a complementary product or might be a service provider for you, have very strong non-disclosure agreement with them. And if you're collaborating, which has provisions in there again, who owns the IP? Jointly developed IP, do we own it? Do you own it? Do we both own it? And certainly anything that's a derivative of your own IP should be yours. So I think that to me is a package of ways to protect your intellectual property as an earlier stage company. I don't know if you have anything to add, Michael, or if you want to hit the next question.
No, I just as far as IP is concerned, you have to assume that, particularly in a tech-oriented investment scenario, the VC, listen, there's a lot of public information that's available about IP, right? You can do patent searches, you can do trademark searches. And so you're going to want to be sure that when the VCs, when your investors go and do their due diligence, that what you present to them is going to match up. Because if you say you own a patent and then they go and they do their search and the owner of the inventor is someone else, then what you've represented to them, that's not a good conversation to have. Okay. Now I think the next 2 questions maybe we can combine, because question, how are shares determined? And then another question, how do you clean up a messy cap stack where you have a bunch of consultants, advisors, and early board members with little pieces of the company?
Small joke, Michael. Unfortunately, we're experts at that. Unfortunately, but go ahead.
Yeah.
Sometimes it's not so bad. It just we don't want people coming out of the woodworks. But so
Okay.
go ahead, Michael. But I mean, the messy cap table. The biggest problem I see, and you see, Michael, is someone that says, "Oh, wait, Mr. Founder, you promised me 5% of your company last year." That's the biggest problem. Or
I mean,
the guy that left the company and still has stock, and you want to buy it back from him. So those are the bigger issues.
You may be surprised or not surprised. How many early stage companies, when they're asked, who are your shareholders? They just kind of stare at you somewhat blankly. Okay. Because look, in desperate times, money comes in. Is it equity? Is it debt? Is it this? Is it that? And sometimes it's really, really unclear. So really the lesson is, it's not a question of, I think, cleaning up the cap stack as much as it is of having clear documentation each time that money comes in. So you don't find yourself in a situation where people thought they were loaning the money and therefore they're actually ahead of the equity investors, where it was your expectation that they were making an equity investment. Okay, so it's really about documentation. And if you get into things like convertible notes, people are providing debt to you on a convertible basis, that the terms of that note are clearly laid out so that if they are to be converted into stock, everybody understands that if that conversion takes place, what class of stock is going to be issued and how much. Now, question about how are shares determined? I think
I can add one thing to that messy cap table question.
Okay, Vince.
It is documentation, and buyback rights are key, very key. Every sort of incentive stock plan you see, you'll enter into a stock restriction agreement that says when you leave, we buy your shares back for some what you paid for them. If they were a grant, we buy them back for nothing. That kind of thing. But I'll tell you the mistake I see a lot is when people promise percentages of the company. So I would, if I'm an early stage person with not a ton of experience in companies, I would never ever use the word percentage ever, because 3% today after dilution is 1% tomorrow. So I would strike the word percentage from your vocabulary when you're talking about equity in your company ever. It sounds simple, but you back into a percentage, but no one gets a percentage of the company. So I've seen a lot over the years. So I'll just throw that out there. And Michael, I'll turn it back over to you.
Yeah, and I think, in terms of the question, how are shares determined? As Vince just said, there's a lot of backing into that goes into these calculations. So the number of shares that may be issued to an investor in the context of a Series A round is going to be a product of the valuation, the pre-money valuation, the post-money valuation, okay? And the percentage of the, I'm not contradicting Vince, but
you back into it, but yeah.
But you back into it, right? And the percentage of the company that the investor is effectively purchasing in consideration of its investment amount. So I think we mentioned earlier that, again, before COVID, right? The median percentage acquired in a Series A round was 25%. So if the company's if the investor is investing, I'm just going to pick a number, $5 million for 25%, right? From there, you can calculate your post-money valuation, and you can calculate the number of shares that it's going to take for the preferred investor to have that 25%. So there's a lot of backing in, or backing out, backing in, and this is where the people who are really, really good with Excel spreadsheets, of which I am not, okay, this is really where they can shine, when they can plug this all into an Excel spreadsheet and the numbers just kind of miraculously appear.
Right, and there's a question to Vince. What is not percentage? What do you use? And I think Michael's got to say, you could talk on the golf course or at the bar. I'll give you a couple of percentage, but I just don't ever like that, because that was a promise and you promised to give me 2% of the company. So, but then you say, well, when you get down to documenting, it's always share numbers. And I just think it's just not, it's a tough practice. It's a no
Well,
excuse. You're back into a percentage, but
and
it all comes down to documentation.
And along those lines, and I know our time is already beginning to grow short, but along those lines, you will have people come to you and they will say, I will never accept dilution. I need a position where I will never be diluted. And I typically say to them, well, if you're able to negotiate that, you don't need me, because it's pretty much an impossible position to take, right? The company cannot grow unless everybody is prepared to be diluted on paper, right? So, you may be at 5%, then additional capital comes in and you're down to 3%. But it was like that simple math, all the math I can do. The simple math I was offering before, your 3% tomorrow is worth more than your 5% today, okay? We have a question here. Go ahead.
Yeah, I was gonna say, do you want to get into a little more on the term sheet so we go move?
Well, let me just see if I can answer this one additional question, okay? Because I see we have about 10 minutes remaining, or maybe less. Is there any difference in any of what you have described if the entity is an LLC and not a corporation? Basically, no, but there may be some different tax implications that would need to be considered. But I mean, basically, so instead of, say, a preferred class of stock, you would have a preferred class of membership interests. Instead of directors, you have managers. So really the core concepts of the economics and the governance would really not be affected by
this, Michael, right? Not to interrupt, but you've been around longer than me. We established that. But you get professional money from a VC. Yeah, we're going to bet 95% of that's going to be a C Corp for lots of reasons.
A Delaware C Corp.
A Delaware corporation for mostly pass-through tax reasons for the investor, and something called UBIT and all that, which are tax and ERISA guys tell us all about. Right. So you'll probably end up, the venture investor will tell you you're going to be a C Corp. That's 90% of the time that's what's going to happen.
Yes. And, going back to the term sheet, there are some things which quite frankly, we're not going to get a chance to talk about with any degree of depth. But, anti-dilution protections, which means, what happens when the next round comes in. Remember, I talked a few moments ago about the conversion price of converting the preferred to common, and how that starts out on a 1-to-1 basis. But if the conversion price, the denominator, goes down, then it's no longer on a 1-to-1 basis. And the denominator, the conversion price, may go down if future rounds of financing are at prices less than the price that was paid by the Series A shareholder. You'll hear terms, typically weighted average, full ratchet. Stay away from full ratchet. It's nasty. Okay, you want to stick with weighted average.
And we think most of the market would be on average weighted. Although you'll see some full ratchet, but it's a tough one. The full ratchet, one share, you issue one share at $1, then this big investment that was valued at $5 for $5 million is now all converted at $1. So it's just draconian, and it just kills the cap table. Just kills the cap table.
And one of the things that we really wanted to emphasize is that term sheets, by their nature, and usually it might say right up at the very top, maybe this one does, I don't know, they're non-binding. Okay. They're an excellent exercise to go through because, as to the question earlier, how long should it take? Well, look, if it takes you months and months and months to get through a term sheet, it's probably just not meant to be, okay? And you as the company have to also anticipate that the valuation that gets put forth for purposes of the term sheet, you hope it holds up. But as the investor does more digging, does more due diligence, it may look to decrease its valuation. So that's one thing. But there are a couple of terms in really every term sheet that are binding and that are very important. One is confidentiality, okay? And the other is exclusivity, right? Or no shop, however you may be more familiar with having that expressed. And what it basically says is once you sign the term sheet, you can't talk to anybody else for some period of time, 60 days, 75 days, whatever it happens to be. And you know that's a big deal, right? That's a big deal. You know, if you're in a situation where you have the luxury of having received multiple bids, multiple term sheets, once you pick one, you're locked. Okay, you're locked for some period of time. So you want to take that very, very seriously, because I've gotten calls, and I'm sure Vince has gotten calls. You know, you're 20 days into the exclusivity period, and it's like, oh, I can't deal with these guys. I go, well, you know, they've got exclusivity. You got to deal with them
for 25 days.
Until they decide they don't want to deal with you, right? So it's a very significant, very significant item.
Right, and one little caveat, and we do these all the time on all kinds of business deals. And for the investor, they want this only because they lock you into the no shop. That's the only reason, I think, to sign these. Well, if you're a buyer of a business, you want the business off the market. So that's the most important thing. I think at this point, I see one more question. Oh, I think the point is, this is the highest amount of negotiating power you have is at this term sheet stage. Yeah. So particularly in the situation where you're maybe talking to other people. So it is important, even though it's not binding, it's binding from a handshake perspective, where term sheet items, it's hard for an investor to walk away from a term sheet item which was negotiated and written onto the term sheet. So even though it's not binding, if it's really, really important, you ought to try to get it into the term sheet, particularly if it's favorable to you, because you probably have the most bargaining power right now.
And so although I promised we were not going to talk about valuation. Question, 2 million investment at 15 million valuation for a seed round. What do you guys think of that? The one I just did last week was a 2 million investment at a $10 million valuation. So
I would say that's good.
So yeah, that's
knowing nothing about the company. That's pretty good.
Yeah, I would just say it's not crazy.
But 2 million is even that's a fair amount of money for a seed round.
Yeah. So that takes us right to about 5:14, 5:15 TikTok, and I know that I think we're going to try to be in the where am I going next, Kirway?
We would like everyone to join you guys in Remo if they have any additional questions, and what I'll do is paste the link to Remo in the chat for everyone, and then once you all are able to successfully get over there, feel free to leave the Zoom meeting, but I'll hang on if anyone has any issues getting over to Remo.
Yeah, I had a problem doing that before, so you'll send that to everyone, right?
Yes.
Okay, thanks.
So thank you for the opportunity. Thank you to everyone. We hope learned a little something along the way. Okay, everybody be safe. Be safe. Be safe.